can say the shopping. Now what has done after 25 years, if I would have not bought that bullet,
Mm.
but I would have sold that money
Mm.
into the company that manufactures that bullet, that is Eicher Motors. So 65,000 not spent but saved and invested in Eicher Motors is worth almost 60 crores now. So 65,000 in 25 years has grown to 60 crores. This is how the money can grow only if you can put it in business. So people don't understand this. I'll give you another example, very recent one. So when I returned to my home again back to Lucknow in 2008, one of my friend, he started a franchisee of a trading terminal, and he opened my account, and he asked me to buy some stocks. So
Mm.
I just bought at that time. I just had bought induction cooktop of Havells. So
Mm.
I was very happy with that cooktop. I
Mm.
asked my friend that what is the price of Havells shares. So he told me that they must be around say 12, 15 rupees per share. So I said, okay, then buy 10 share of Havells. So he bought 10 shares of Havells at 15 rupees each in 2008. And after a few months, he shut down his business. He switched to some other industry and he left. I also forgot that I had some shares of Havells. Okay. Recently, this year itself, the franchisee company they might have upgraded their systems. So I got a mail from that company that you have 10 shares of Havells costing this much, and the price of each share is now almost 1500. So a 15 rupee share in 16 years is now of 1500. 100 times it has grown. In 16 years, 100 times. This is how the money can be sold. Now, the only question is everybody is not aware where exactly to put the money. Then it's best to choose a good gardener, a
Mm.
good farmer. And that good farmer is nothing but a good mutual fund manager. So a
Mm.
mutual fund manager, he is actually a gardener who knows where to sow your money. So if I am not an expert in agriculture or I don't know where to sow my money, it's better I find a good gardener. I give my money to that gardener. He'll take care of my money. Okay.
Mm.
This is how anybody can become rich. And what I have done as a calculation, I'll give you a very simple one, that if somebody just takes out 20% of his income, just
Mm.
20%, and he sows that income in just any of the top 10 equity mutual fund, any of the top 10. In
Mhm.
12 to 15 years, that 20% will start giving you a income that is equal to your own actual income. So whatever you are earning as a hard income in your current year, an equal amount will be earned by your savings also in that year. So just 12 to 15 years, and you can create an income clone of yourself. And
Mhm.
then life will start compounding faster and faster. This is how money can be sown. Anybody can become wealthy. Anybody, no matter what the income is.
Right, right. That's really insightful. So you mentioned this 20%. Is there like an ideal ratio that a person should be investing? Is there a rule of thumb, or does it depend on the person?
Okay, good. So this question is often asked that how much should I save? Okay.
Hmm.
My only question in answer to that is that how fast you want to create an income flow.
Hmm.
So, do you want a clone after 30 years, or after 20 years, or after 10 years? How fast you want a income clone of yourself? If
Hmm.
you want, so if 20% can generate an income clone in 12 to 15 years,
Hmm.
obviously 40% can generate an income clone faster.
Hmm.
So if somebody can hold on to his expenditure,
Hmm.
save more, he can create an income clone maybe in 8 to 10 years or maybe 6 to 8 years. So my only answer to that is that why not work hard to create as many clone of yourself.
Hmm.
So the only answer now is that how to survive. Because I always say to a youngster, I definitely say that if you are earning 100 rupees, invest 100 rupees. Then the obvious question is, then how will I survive?
Hmm.
So just take out enough money for your survival.
Hmm.
Rest everything should be invested to create that income flow so that you can be compensated or complemented by your own flow and the pressure eases out. So this is the thing. Otherwise, if you take the rule of thumb, then definitely nothing less than 30%. Even if it is you can say if it can be tough on you, still nothing less than 30% should be the saving. Okay. So first option is as much as you can save.
Hmm.
Next is if not, then minimum 30%. Anything less than that, then definitely you will keep on working for all your life, and I don't know whether you will be able to get free or not. Okay.
Yeah.
Hmm.
I feel like it's more mindset when it comes
Exactly.
to saving. Like we cannot, if our peers are buying something and something is trendy, like recently this water jar was very trendy and it was just a
Hmm.
jar, the Stanley one, to sip
Exactly.
water, but it was very expensive. But everybody kept on buying it because just because it was trendy. So I think a psychological thing of controlling also plays a role when it comes to.
That exactly is what I was saying, your propensity to save.
Yeah.
So a person who has a better FQ, financial quotient, he
Mm.
will have a very good propensity to save. He'll
Mm.
not get attracted by what others are doing. He'll just be guided by what his actual needs are. So if my phone is working fine, I don't need to upgrade it. Just because all of my peers have upgraded, I don't need to upgrade it right now, as long as it is doing well. So when it is, you can say it is creating trouble for me, then definitely I can change.
Right, right, definitely. Okay. So, so your income theory also suggests that a person invests for their entire life. But
Hmm.
entire life mein to, big calamities have happened, big volatile periods come, overvaluations come. So, what should we do then? Like, should it stay
Okay.
the same?
So you mean to ask that there are situations like say COVID or
Hmm.
maybe 2008 financial crisis. So there are crises when
Yeah.
the market goes down and it goes down a lot, maybe 30%, 40%, 50% also. So
Yeah.
in that case, what should be done? Okay. Should we remain invested? Should we get out and wait for the right time and get again at the right time? Okay. So
Hmm.
I'll answer that. So the question is not about getting out of that train. Okay. The question is only about inside that train itself, you have options where you can switch. So first of all, everybody should start with an asset allocation. Asset allocation is something that why put all your money in one thing? You need to put your money in different asset classes. So
Right.
one broad category is equity and debt.
Hmm.
Equity means your money is going to the stock market and it will generate profit and losses. Debt
Hmm.
means you are simply lending to the company. So
Right.
this is the broadest classification of asset class equity and debt. Within equity itself, you can have different asset classes. So there is a book by an author, Chris Hogan, Everyday Millionaire. Everyday Millionaire is a book in which Chris Hogan has studied almost 10,000 millionaires. 10,000, it's a huge number. So
Yeah.
studying 10,000 millionaires who have become millionaire by ordinary income. So these were people who were not extraordinarily rich, just common people, accountant, teachers, lab technicians, or maybe TT, etc., bus conductor, very ordinary people.
Hmm.
And they have generated a wealth of a million in 20 years of investing. So he studied those and then he tried to find out is there a pattern that all these people used. So he gave up a very simple asset allocation. Number one, he told that if you want to grow your money or if you want to generate wealth, then you have to uh, can say get rid of two extremes. One extreme is you have to avoid fixed returns. That is extreme of safety. So you have to avoid that extreme. Another extreme that you have to avoid is you don't have to get into, say, cryptocurrency or quick trading. So trading and cryptocurrency is avoided because that is highly risky.
Mm.
FD is avoided because that is highly safe. In
Mm.
between lies four asset classes. Number one, invest in 25% of your money, invest in international funds. Number two, 25% of your money invest in large cap, 25% in mid cap, 25% in small cap. So this is the spectrum that most of these 10,000 millionaires used. Now what happens? Whenever there is a down in the market or there is a correction in the market, not all the asset classes are down equally. Okay. So asset classes, maybe it is the small cap is hit more than the large cap. Maybe Indian equity is hit more than the international. So all these asset classes move at a different, you can say, value. Now,
Right.
what you can do is, I don't have to bother about the external equity situation. I just have to take care that if my asset classes have moved more than plus minus 5% of
Mm.
their original allocation, then
Mm.
I need to rebalance it. So I started with 25, 25, 25, and 25. Now, for some reason, one of the 25 has become, say, 30. So
Mm.
it has moved plus 5% from its original allocation.
Right.
Now I can rebalance. So I will again make everything 25 each.
Mm.
This is called rebalancing. So if somebody just decides on an asset allocation and then rebalances it whenever the asset allocation moves plus minus 5%,
Mm.
then this strategy gives the best result to that person. What asset allocation one can start with, he should definitely sit with an advisor who
Mm.
will look into his particular situation and then decide what asset allocation will suit him best. So somebody can start with, say, 20% gold,
Mm.
20% international, 20% large cap, 20% mid cap, 20% small cap. So this is an asset allocation that suits one type of investor.
Mm.
Another type of investor can start with maybe, say, 30% in large cap, 30% in mid cap, and maybe remaining money in large international funds or something else. So
Mm.
this is how you can start with an asset allocation. You sit with an advisor to fix upon an asset allocation, then
Mm.
just rebalance it. This is the best way. You cannot guide or you cannot steer the market. You can only steer your car.
Very
So
good.
market is just like a highway taking a turn. I
Mm.
cannot do anything if I don't have a steering.
Right.
So steering or asset allocation is like that car. Now you can
Mm.
steer your car so that you are on the right path always. You
Right.
cannot change the highway. Okay.
Right. So just to confirm, you said ki whatever's value is increasing 5% and the other ones is decreasing 5%. So we need to like shift this increased amount to that decreased amount, right?
Exactly. If
Okay.
there is fresh money,
Right.
obviously you don't have to make a switch. You will put in more money into that asset that has gone down, and
Okay.
you put in less money in the asset that has gone
Like
up.
you bet on the
If you have fresh
loser.
money. But if somebody doesn't have a fresh money
Hmm.
and he has to make a switch, then he will rebalance by taking out from you can say plus or from a gainer and topping it up into the loser. This is what has to be done. But this
Right.
has to be done systematically.
Yeah. The loser has to have potential. It's not like a loser is
Exactly.
a real loser and you keep putting in money. So that's where.
Money is always made in small cap and mid caps category.
Hmm.
Large cap and international funds, they are good for holding the profits.
Hmm.
But money is always made in mid cap and small cap. So when mid cap and small cap is down, we
Hmm.
need money to top it up. Then we'll take out from large cap and international and top it up. But again, when mid cap and small cap will perform, they are
Hmm.
much above the others. We have to take out some of the profit and still hold that profit in large cap or international. So you have to keep rebalancing. This will generate. Chris Hogan has given a number. He
Mm.
has given a number of approx 20% of return with this strategy. And
Mm.
20% is good enough, not bad.
Definitely. You didn't mention debt in any of this?
Debt definitely. See, when you are creating wealth,
Hmm.
you don't require debt. Debt is required when you are approaching your goal. Now you need to offload your equity investment to debt maybe 2 years, 3 years before the goal. Or if the goal itself is 2 to 3 years from now, then there is no point in moving to equity. So I explain it in this way, sir. Say, for example, I have ordered something or I have a huge consignment coming from Kerala. Okay. And say, suppose I live in Lucknow. So that huge consignment can come into a big trailer. So from Kerala to Lucknow, it will come into a trailer. But
Hmm.
that trailer cannot come to my home because it's too big. So I have to offload that into small, you can say, वो अपना जो छोटा हाथी आता है, small, you can say,
Cargoes
trolleys
and
or
things
what,
like that.
small cargo,
Hmm.
and then it can come to my home. So for long run, it is always equity, but as soon as the goal approaches, the equity has to be offloaded and has to come to debt so that you can take it home. Directly from equity, you cannot take it home. That is very risky.
Hmm. Right.
Okay. So
So that is why when
very handy. Debt comes very handy in that situation.
right, that is why when a person is a little aged or
Hmm.
their risk profile is less, then we kind of try to mix hybrid funds and all of that.
True, true.
Right. So, coming to the next question, it's a very interesting one. So, like you said, that you have to stay invested on the course of corrections and all of that. What about overvaluations? Like, how would you explain market valuations in the most basic sense? Can an investor time such valuations? Like, if, yeah.
So good. That's a good question. So overvaluations, as I explained, is very simple. Uh, just take an analogy from a young child. So say for example, there is a 10-year-old boy. Okay. Then everybody is aware that what should be his weight. So for a 10-year-old boy, an Indian boy, maybe 30 kg is a decent average weight. So a 10-year-old kid should be of 30 kgs. Okay. How have we arrived it? Because scientifically, for a age, there is a weight. Or when it is an adult, then maybe not with age, we go with height and weight. So there is a ratio of age to weight or height to weight that tells us this is something normal. Okay. But suppose there is a 10-year-old boy, but his weight is 50 kg.
Hmm.
Definitely, it is clear he's overweight. Okay.
Hmm.
Now, if this 50 kg boy works out a disciplined diet plan, some workout, and he loses weight, and now he is say 35 kg. So he has lost 15 kgs. Okay. Is it a good news or a bad news?
It's a good news.
It's a good news
Hmm.
because the boy was already overweight, and when he's correcting his weight, it is actually a good news because he's in a growing age. With that overweight, he cannot grow forever.
Hmm.
Even if he would have grown, he would not have grown healthy.
Hmm.
So for a healthy growth, he needs to be in a normal range and then he can grow again in a healthy manner.
Right.
Same happens with the market. So market also, if it needs to grow in a healthy manner, it has to be in a range. That is a normal valuation. But sometimes it is overvalued. So there are ratios, very common ones, say for example, PE ratio, so that is price to earning ratio, or again a very common indicator that is Warren Buffett indicator. That is very common to explain. Warren Buffett says that market capitalization of all the stock market divided by the GDP or the income of that country. Okay, that should be around 75%. That is normal. Up to 100%, it is slightly approaching the overvaluation.
Hmm.
Beyond 100%, it is definitely overvalued. Okay.
Okay.
So currently also that Warren Buffett indicator for India is almost touching 100. So we are now on almost on nearing the overvaluation that spot. So if say it grows is still above 100, then definitely it is overvalued and it will correct itself. And
Yeah.
that is good
Rate
also
cuts
for
are
the
coming.
market, because market cannot grow healthy forever if it does not correct itself. It cannot remain fat and grow healthy. It has to correct and then grow healthy. But the question is, when should I take out my money? Should I take out when it is overweight and should I put it when it is underweight? This is a situation that is not possible, not available. Why? Because market moves like a pendulum.
Hmm.
So it passes that normal valuation and it moves toward overvaluation, and then it touches an extreme and before it starts returning. So when it returns, it again passes that normal valuation and
Hmm.
it goes to undervaluation. So it swings between undervaluation and overvaluation. And it is very difficult to point out that this is the value of return. So best thing is again asset allocation. So I don't have to worry about that swing. I just have to focus on my asset allocation. So I started with say 25 each in four asset classes. Now I just have to check that because of any of the swing, if it has any of the asset classes moved plus minus 5% in absolute number,
Hmm.
then it is a time to rebalance. So if you just rebalance your own asset allocation, you don't have to worry about what's happening in the market. I don't have to bother.
Hmm.
And this is the best thing. So my focus should be on my car, not on the highway. Highway will turn whenever it wants to turn. I cannot do anything. I can do whatever I want with my own asset allocation, with my own portfolio. And that is in my total control. So when people say I'm not in control, you are in absolute control if you focus on your asset. If
Right.
you focus
Right.
on market, you are definitely not in control because market is nobody's control.
Right.
Okay.
Risk also we can control this way.
Exactly. So that asset allocation itself is a control.
Hmm. Right.
So
That's
I'm diversifying the risk while putting my money into different asset classes.
right.
And
Right.
that depends on each individual. So if somebody is a risk taker, definitely he can have higher side of equity. If
Hmm.
somebody is not a high risk taker, he can reduce the equity portfolio. But that decision has to be taken with an advisor, not alone. Okay, I'll give you another analogy. Many of the time people say that everything is coming out of stock market. Then why not directly buy stocks? Why go to mutual fund?
Yeah, that's a
It's
very
a
valid
very
question.
common question.
Yeah.
My answer to that is that see whatever we consume as eatable, whether it is grain, wheat, bread, vegetables, fruits, whatever we consume, all the nutrition that is protein, carbohydrate, fat, vitamin, mineral, that is extracted from the soil itself.
Hmm.
So from the soil, everything is extracted, and then we eat that grain or vegetable or fruit. So if everything is coming directly from the soil, why don't we eat the soil?
Hmm.
The only reason is our bodies are not in a position to digest soil.
Hmm.
We can only digest grain or vegetable or fruit,
Hmm.
not soil. Soil is stock market. And if you go to any trading terminal, any trading site, there is a pop-up from SEBI that says 9 out of 10 stock market traders are at losses. 9 out of 10. So it simply means that 9 out of 10 people are not able to digest what stock market is giving. Only 1 out of 10 is able to digest it. So I may not be that lucky one. So better assume that I may be that 9 out of 10 category. So it's better to go via mutual fund route. Mutual fund is going to convert that return from that soil and it will give you in a way that you can consume and digest. So
Right.
that is the best way to consume returns from the stock market, not directly. That can
Right.
be risky. that is definitely risky. There is a pop-up from SEBI.
So the millions of traders that do it every day consider themselves in the 1%.
Exactly. Everybody feels that he is that 1%.
Yeah, yeah,
But
but not
but
the that.
every day 90% of those traders,
Yeah,
they are at loss. Every day.
yeah.
That's very common.
Even I've seen a long-term study wherein a trader is showing his intraday profits and losses, and on a very long-term perspective, like 5 to 7 years or 8 years, that profit is actually lesser than a stable equity fund and all.
Exactly. Exactly. So that is not digestible by everybody. So money definitely compounds in that soil of the stock market, but that soil is not digestible to everybody. Let's leave it to a fund manager who is a expert gardener who can decide which plant to sow and when. So let's leave it to him. As a common investor, my focus should be on number one, how much can I save?
Hmm.
Number two, can I invest all that I saved wisely? That's
Hmm. Yeah.
that's it. Nothing else.
And when I have to steer in what direction when the
So
that
that will be decided by asset allocation that
yeah.
I have decided along with an advisor.
I really like your perspective on having control because a lot of investors feel that while the market we have no control, like whatever is happening, but it's actually in all our hands. So thank you so much, sir, for this insightful session.